Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, and welcome to another episode of On My Way to Wealth. My name is Luis Rosa, and I'm your host. This is episode 51. Happy New Year, everyone. I wanted to talk to you today about taxes. Tax season is upon us. The IRS is starting to accept tax returns towards the end of the month. And I know a lot of us are going to start filing our documents soon, right? So just wanted to talk a little bit about some tax basics so that before you file, you have a full understanding of how our tax system works. So America has what they call a progressive tax system. And all that means is that as a person makes more and more money, they basically pay more and more taxes. You progress through these tax brackets based on your income. Each level of income is then taxed at a different bracket. And I'm going to put that in the show notes because I definitely don't want to bore you with all the different brackets for every income and filing status. But ultimately, there are 7 different tax brackets right now as of the recording of this podcast under the Tax Cuts and Jobs Act that was done in 2017. And they are scheduled to end by the end of 2025 unless Congress changes it. So as of right now, there are 7 different tax brackets. 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So what that means is that a portion of your money gets taxed at 10% first, then the next dollar inside the bracket gets taxed at the next tax bracket, which would be 12%. And then the next bracket is 22. So not all of your money gets taxed at the same rate, which is great. So the more and more money you make, the more taxes you pay, but not on all your money. What's called a marginal tax rate is basically the tax rate that you pay on your next dollar. So I'm going to give you some examples just so that you have a good idea of how that works. And also, again, just be sure to check the show notes because I'm going to put a direct link to the IRS tax tables just so that you understand how the brackets work. Now, typically every year, the IRS also increases these amounts within the bracket, adjusting for inflation. And what that means is that every year, more and more of your money falls into, it's within that bracket, so it's kind of good that they do that so that you're not then paying taxes at the next bracket, the more money you make, without that adjustment for inflation, which is great. So yeah, let's get into it. So number one, not all of your money gets taxed at the same rate, right? So you have those 7 different income tax brackets right now. Number two, not all of the money that you make actually gets taxed either. So I wanted to talk to you a little bit about the concept of standard deduction. I know a lot of you probably hear that. You probably also hear a lot the word itemized deduction coming into play, and you're like, what is that, right? So let me tell you a little bit about what those are. So there are 2 things that you can do many things you can do, but when you're filing your taxes, there are 2 ways in which you can reduce your adjusted gross income in order to calculate what is actually taxable income. And one way that the IRS does it is they let you take what they call the standard deduction amount. And that is a set number based on your filing status. And basically there's no questions asked. You're just able to take that and deduct it from your adjusted gross income in order to arrive at your taxable income. So I'll give you an example, and I'll do a single person just to keep the numbers simple. Let's say you're single, you happen to make $60,000 a year, right? When you look at the IRS standard deduction for a single person in tax year 2020, which will be the tax year that you're filing in 2021, the IRS lets you deduct from that figure $12,400. That is a standard deduction for a single person. It doubles for married filing jointly. It's $24,800. For head of household, is $18,650. But let's continue with this single person, $60,000 a year gross income on a W-2. Very simple. So $60,000 gross income shows up on your 1040, but then you end up taking the $12,400 standard deduction from that 60. And in reality, only $47,600 of your income is actually taxable income under this scenario, which happens to fall in the 22% tax bracket. The large part of it falls in the 12%. And then you bump into the 22% bracket for the remainder part. Now, itemized deductions, same concept, but the IRS lets you take whichever number is bigger. So there are certain things that you can use as itemized deductions. So what you do basically is you keep track of them, and every year you can decide whether to take the standard deduction or the itemized deduction. So one of the most common deductions is mortgage interest on a primary residence, for example. So if you paid, let's say, $8,000 in mortgage interest and you had charitable contributions of $2,000, and those were all your deductions for the year. And let's use the same example of the single person making $60,000. $8,000 in mortgage interest plus $2,000 in charitable contributions is $10,000. Now, the standard deduction in 2020 for a single person is $12,400. So what you would do, you would take the larger amount because it would result in a lower taxable income for you. Now, if the itemized deductions that you have happen to be higher, then you would take the higher number, which will give you a lower taxable income. So let me give you an example. Continuing with the same single person that makes $60,000, standard deduction is $12,400. You end up getting $47,600 of taxable income. If you had $15,000, so in the same example I gave, let's say you had $8,000 in mortgage interest, $2,000 in charitable contributions, and another $5,000, say, in property taxes, you would have $15,000 in itemized deductions, which is actually bigger than $12,400. So what you would do then is you would itemize your deductions instead of taking the standard. Under this scenario, your taxable income is $45,000 as opposed to $47,600. So the difference between those two numbers is $2,600. Now, that doesn't mean this $2,600 is going to you. What that means is you're paying taxes on $2,600 less because your itemized deductions were bigger than your standard deduction. So at the 22% tax bracket, you're saving 22% of the $2,600, which is $572. So that's one way for you to reduce your tax liability. And this brings me to another point, because you hear the word deduction all the time. So I just explained the concept of standard deduction. When you qualify for an itemized deduction, all you're doing is reducing your taxable income. It's not a dollar for dollar effect. So when you are able to deduct something, let's say it's $1,000 worth, it doesn't mean that you're getting $1,000 back in your taxes. So a lot of people have that misconception, like, oh, I just deducted in my taxes. Whatever you're eligible for to deduct is something that's just going to lower your taxable income. So, but it's not dollar for dollar. So in this example that I gave you, that $2,600 deduction is just deducted from your income. So it's $2,600 that is not taxed. So in essence, you save what you would have paid on that money. In this case, 22%, which is $572. So a $2,600 deduction, quote unquote, results in a $572 actual benefit to you in this scenario. So that's something that I want you to keep in mind, because a lot of people just think that whatever you can deduct in your taxes results in some sort of dollar for dollar benefit to you, right? So, which brings me to my other point, tax credits. Now, tax credits are actually much better than a deduction, because a credit actually directly reduces your tax liability, as opposed to a deduction that only chips away at your tax liability. So if you're getting a credit that is worth $2,000, for example, say the child tax credit, $2,000, you're actually getting a $2,000 benefit dollar for dollar. So if your tax liability was going to be $3,000 and you're getting a $2,000 credit, now it's only $1,000 because you can deduct that $2,000 from the amount that you owe. So a credit is actually much better than a deduction whenever you can get one, right? So something to keep in mind, I know a lot of you do your own taxes, and that might be fine if you just have a simple return, W-2, things like that. Most online programs, software just allow you to enter the numbers from the boxes and it's fine. But if you have a bit more of a complex situation, maybe you're married, maybe you have side income, you're in school or kids in school, things like that, you want to make sure that you understand what credits you qualify for, because you want to make sure you don't miss out on those, because those could be very beneficial to you. So what are other ways that you can reduce your income even before you file your taxes? One thing that you can do during the year, a lot of us contribute to 401ks, right? So that's another way where, let's go back to that single person that makes $60,000. If you make $60,000 and let's say you contribute $5,000 to your traditional 401k at work during the year, the IRS is only going to tax you on $55,000 this year. So now you lowered that 60 to 55 by contributing to your 401k at work. And then let's say you itemize on top of that. And in the scenario that I gave was $15,000 itemized deduction. When now you just brought your income all the way from 60 down to 40,000 because you were able to reduce your gross income by $5,000 in your 401k, brought it down to 55. And then when you subtracted your mortgage, property taxes, and your charitable contributions of 15,000 in this case, and I'm using round numbers just to keep it simple, you're actually down to just $40,000. And that's a pretty smart move because then you kind of made all of your income basically be taxed at the 12% bracket. For 2020, the top number, the range is between 9,876 and 40,125. So there are strategies that you can use. And these are the kinds of things that you can talk to a financial planner or an accountant about to see what you want to do during the year or what you can do during the year, things you can take advantage of in order to lower your tax rate. Now, in the example that I gave, it was contributing to a 401k can reduce your taxable income today. Now, there are some consequences to consider because eventually the IRS does want to get taxed on that money. So if you take that scenario where you're lowering your taxable income today because you're contributing to your 401k, then that's fine. But ultimately, eventually, when you take that money out, it's going to get taxed at your ordinary income taxes at whatever tax bracket you happen to be when you take it out. If you wait until the age of 59 and a half, typically, you would only pay income taxes on that money. If you take it out before age 59 and a half, you will pay income taxes plus a 10% penalty. So traditionally, for those people who happen to be in a lower bracket already, like if you are in the 12% bracket or the 22% bracket, one of the things that I usually would look at with my clients is consider maybe doing the opposite if you have the ability to contribute to, say, a Roth IRA as opposed to the traditional, because the Roth is the opposite, where you do not get a tax deduction today, but then the money gets to grow. And eventually, if you follow certain rules, will be tax-free as long as you keep it for a minimum of 5 years and you wait until the age of 59 and a half, all that income that you take out then will be tax-free. So it's something to consider. And that's one of the strategies that you can use and determine, but at least you're making that conscious decision and you're doing something that you know what the consequences are. You're choosing to either forego a tax deduction today because you'd rather let that money accumulate tax-free, or you're choosing to lower your taxable income. Typically the more and more higher you go through the brackets, and a lot of people just choose to lower their income taxes today and contribute traditionally. But more and more employers are offering Roth 401ks now as well. And that's a great option to take advantage of, especially when you are in the lower brackets. So definitely something to consider, speak to your financial planner about. Now, there's another separate set of tax brackets that you have to consider, and that is capital gains taxes. So remember when I said not all of your income gets taxed at the same rate? That applies to your ordinary income, but then capital gains have their own separate tax bracket system. And it's much simpler. As of right now, it's only three, is 0%, 15%, and 20%, sorry. So capital gains, well, let me tell you what those are. It's when you sell an asset that you had at a profit, you will have what's called a capital gain. There are some exceptions, obviously, like primary residences. There is an exception. If you've lived on them for 2 out of the past 5 years, you can sell, if you're a married couple, up to $500,000 or $250,000 if you're single, without having to pay capital gains tax. But let's say something more common like a stock. You went online, you open up a brokerage account, you bought a couple of shares of company XYZ. Eventually, when you sell those shares, if you sell them at a profit, you're going to pay capital gains taxes. However, there are two things to consider. It's either going to be short-term capital gains tax or long-term capital gains tax. Short-term is anything that you held for 1 year or less. So this is another planning strategy that you can do. Because if you happen to sell something that is considered short-term, meaning that you held it for a year or less, forget about the 0, 15, and 20% tax brackets I told you about. You're going to pay ordinary income tax, which is tax at whatever tax bracket you happen to fall under. If you hold it for more than a year, it's considered long-term capital gain. And then you pay either 0%, 15%, or 20%, depending on your taxable income for that year. So for 2020, to give you an example, if you made anywhere between 0 and 40,000 as a single person, long-term capital gain rates were 0%. If you made between 40,000, $1, and all the way up to 441, 450, you pay 15% on any capital gains, and then 20% for people that make over 441, 451, single filers. So something to keep in mind, because that could be another strategy. You might be getting rid of a stock, for example, and maybe you're close to that year, and it might make sense to wait depending on, obviously, your expectations of whether that's going to rise or fall, et cetera. So another thing to talk to your financial planner about. But that could be a planning strategy because, if you're that close, it might make sense to wait to pay the lower rate versus just selling it at your ordinary income tax bracket, right? So, yeah, I hope that this gave you some clarity as far as what a standard deduction is, what itemized deductions are, also the difference between deduction and a credit, and also how the tax bracket system works. And I'll be putting in the show notes a link to the IRS website where you can look at the different tax brackets in case you want to look them up yourself. As always, if you have any questions, send me an email. Be sure to check out the LatinXcellence movement. Is something that it's a baby of mine, a new endeavor of mine, and put it in the show notes as well. You can check out LatinXmovement.com or look it up on Twitter and Instagram and Facebook at LatinX Movement. All right, so it's LatinXcellence. Check it out. If you have any questions, send me an email. If you want to set up an appointment, you know how to reach me, Luis@onmywaytowealth.com, or just visit onmywaytowealth.com and hit the contact us button. And if you have any ideas for a future show or anyone that you'd like me to interview, you would like to make an introduction, I'm always open for that as well. So thank you all for tuning in, and see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.